Yeah. So good evening, students. I hope you have solved the sum given in the last lecture as homework. And first of all, I would like to know your doubts or with respect to that poem concept which we had dealt, and indirect transfer also if you have any doubt. And let me know the answers also for that sum. So first we'll discuss that sum, and then we'll proceed further. So quickly in your chat boxes, please give me the answer for that particular indirect transfer sum which we had discussed in the last class. What are your answers? Quickly give me in your chat boxes the answer for that particular question. Whether indirect transfer provision was applicable and what was the capital gain if at all it was applicable. What are your answers? Whether indirect transfer applicable in that case? Have you solved that sum? Sure, Anjali. Leela, yes, your answer is correct, but tell me the capital gain amount. Raghuram, what is the amount? What are the amount of capital gain? Okay, let's solve simultaneously and you will understand the concept also if at all you want to revise it again. So, what are the provisions for indirect transfer applicability? The share of the foreign company, will be deemed to be situated in India if if value of the share, what is value? We have to take into consideration the FMVs. Value of share of foreign company derives its value substantially from Indian assets. Right? How do you decide the value? How do you determine the value? The value of Indian asset should be greater than rupees 10 crore. And value of Indian assets should be greater than equal to 50% of value of all assets owned by foreign company. Clear? So these were the two conditions. Value means FMV. FMV as on which date? The specified date. How do you decide the specified date? How do you determine the specified date? So if book value of assets as on date of transfer, if book value of assets as on the date of transfer exceeds the book value, exceeds by 15% the book value of assets as on last date of accounting year preceding the date of transfer. If the answer is yes, then date of transfer. If the answer is no, then date of accounting year. Clear? So in this particular case, let's understand. In this particular case, first of all, we have to decide what is the specified date. What is the specified date? Now, what is the specified date in this particular case? What is the specified date in this case? In this case, the specified date, you have been given the book values, right? You have been given the book value. The book value of assets as on the date of transfer was how much? Book value as on the date of transfer. One second. Was rupees how much? 30 crores. Book value as on the date of transfer is rupees 30 crores. This figure, right, is rupees 30 crores. Correct? And book value as on the last date of accounting year is 25 crore. Right? So does it exceed 15% of the book value of total assets as on the last date of accounting year? The answer is yes, it exceeds, right? So the difference between the book value of the assets as on the date of transfer and the book value of assets as on the last date of accounting year exceeds 15% of the book value of assets as on the last year of accounting year, correct? So in that case, specified date would be 31st March 2021, right? Specified date would be 31st March 2021, correct? Now, value of assets, Indian assets, as on 31st March 2021. What is the value of Indian assets as on the date of 31st March 2021? It is, you have to consider without reduction of liabilities, which is this amount, 200 crores, right? Without reduction of liability, it exceeds 10 crores, correct? It exceeds 10 crores. So, FMV of Indian assets is 200 crore. First condition is 10 crore. Now, for the second condition, the value of Indian assets should be more than 50% of the value of all assets. Now, whether you have to take the entire 200 crore, the answer is no. you have to take only 200 crore into 20% is equal to 40 crore. Why that is so? Because as I said in the last lecture, you have to pay attention to the first line. What was the first line? RIL is an Indian company. Fubon USA is a US incorporated company. It wants to get 20% holding in RIL. So not the entire holding is there of Fubon in RIL. Only 20% is there, right? So in that case, how much would be taken into consideration as the value of assets held by Fubon? Only 20%, correct? So in that case, 40 crores would be the value of assets which would be taken into consideration. Clear? Now, how will you determine whether it substantially derives a value from Indian assets? So 40 crore divided by what is the value of all the assets as on 31st March 21? What are the value of all assets as on 31st March 21? It is 50 crores, right? It is 50 crores. Correct? So 40 divided by 50. This is more than 50%. So therefore, indirect transfer is applicable. Clear? Indirect transfer provision are applicable. Now, how will you compute the capital gain? How will you compute the capital gain? Full value of consideration. What was the full value of consideration? It transferred at a price of rupees 50 crore. So this is the full value of consideration, right? It had acquired the shares of this Mauritius company at what price? It had acquired the shares of Mauritius company at rupees 10 crore in 1/1/2019, right? So how much it would be? 10 crore. So therefore, how much will be the capital gain? How much will be the capital gain? 40 crores. Right? It will be 40 crore. Whether it will be short-term capital gain or long-term capital gain, it will be long-term. As held for then 24 months. Clear? Held for more than 24 months. Now, whether this entire capital gain will be chargeable to tax in India, the answer is no. We had learnt in the last lecture that only to the proportion of the assets in India, the capital gain will be chargeable to tax in India. Correct? So, out of that 40 crore, into 40 divided by 50. This is the value of Indian assets. This is the value of all the assets of that Mauritius company, right? So only this much proportion, this is A into B divided by C, correct? This much will be chargeable to tax in India. So only capital gain amount is 32 crore, which will be chargeable to tax in India. Clear? Clear? And what will be the capital gain tax on this? What will be the tax rate? These will be not the listed shares. Shares of RIL are not sold. What is sold is, what has been sold is the Mauritius company's share. So therefore, these will be unlisted shares and not the listed shares. Remember that. And for unlisted shares, in case of a non-resident, the tax rate under 112 is, under section 112 is 10%. Clear? Do you have any doubts? Do you have any doubts with respect to this question? You can ask me now. Did you understand this question? Anjali, did you understand? Any doubts with respect to this question? Any doubts? Raghuram, we added 20 crore liabilities because I had told you, if you see in the last class, I have told you, I'll show you once again, that FMV is to be taken without reduction of liabilities. And it is assumed that this FMV is after the reduction of liabilities. If you see, FMV without the reduction of liabilities. Clear, Raghuram? Any other doubt? Perfect, Anjali. Ambika, you can copy the sum later on from YouTube. No doubts, the sum is clear. So then we proceed further. We proceed further to the next part then. We are done with section 911 and now we shall look into the other parts of section 9. Now, salaries deemed to accrue or arise in India under section 912 and section 913. What does section 912 says? That salaries in respect of or payable by any person in respect of services which are rendered in India. Services which are rendered in India will be deemed to accrue or arise in India. Meaning thereby that even if, say for example, there is a non-resident person, right? There is a foreign company who is sending its employees to India on secondment, or is deputing its employees to India for providing some services in India. In that case, salaries payable by a foreign company to non-resident employees, they may not be resident in India, right? In that particular case, the services would be rendered in India. The employees are performing the services in India, and therefore the salaries payable by that non-resident company to its non-resident employees in India would be deemed to accrue or arise in India and would be chargeable to tax in India in the hands of non-resident employee. Clear? So whether the foreign company is required to deduct the TDS, whether the foreign company is required to deduct the TDS on that particular payments made to its employees, whether the non-resident company is required to deduct TDS under section 192, the answer is yes. 192 also says any person. 192 also says any person, be it resident or non-resident employer, right? So in that particular case, they will be required to deduct the TDS on the salaries which they are paying to their employees, because these salaries would be deemed to accrue or arise in India. Are you clear? Are you clear? 913 says, on the other hand, 913, is the salaries payable by government. 913 talks about the salaries payable by government to citizen of India. To citizen of India for services rendered outside India. 913 talks about salaries payable by government to a citizen of India in respect of services rendered outside India will be deemed to accrue or arise in India. Why? Because our government is paying them. So if Indian government is making payment to its employees, say for example, to employees who are working outside India for services rendered outside India and they are citizen of India, in that case, the salary would be deemed to accrue or arise in India. Clear? If allowances or perquisites are paid, then there is an exemption under section 10(7). Then there is an exemption under section 10(7). Clear? So this is just in case of salaries which are said to be deemed to accrue or arise in India. Section 914 talks about dividend deemed to accrue or arise in India. Dividend deemed to accrue or arise in India. Okay. So now till last year, till 2000, before 2020, dividend was exempt in the hands of the shareholder. Why? Because DDT was paid by the Indian company when the dividends were declared. Now, from Finance Act 2020, this has been amended. This has been amended to now DDT has been abolished. There is no DDT on the Indian company. Now, dividends will be taxable in the hands of the shareholder. In the hands of the shareholder, be it the resident or non-resident. So, if the dividends are declared by Indian company, in the hands of individual, the dividends would be chargeable to tax and it ranges from 10.4% to 35.88%, including surcharge and cess. It is taxable on slab rates. In the hands of LLP, it is taxable at the rates of 34.94%. In the hands of non-resident, it is taxable at between 10.4% to 35.88%, non-resident individual. Clear? If it is a foreign company, they are taxable under section 115A. Dividend received from the foreign company is taxable under section 115A and 115 BBD, that we'll deal later. And in the case of foreign company declaring to non-resident, it is not taxable. Clear? So dividends paid by an Indian company outside India shall be deemed to accrue or arise in India. Dividend paid by an Indian company outside India shall be deemed to accrue or arise in India. Clear? And now, earlier it was exempt in the hands of shareholder. Now it is taxable in the hands of the shareholder, whether resident or non-resident. Clear? Which dividends will not be deemed to accrue or arise in India? I had said in the last lecture. If the foreign company's share derive their value substantially from Indian assets, then dividend declared by the foreign company will not be considered to be deemed to accrue or arise in India. But dividend paid by an Indian company outside India will be deemed to accrue or arise in India. Are you clear? Next, interest, royalties and fees for technical services deemed to accrue or arise in India. Now this we shall look at it together. But before that, do you have any doubts? Any doubts? Gomati, I'm doing non-resident taxation and I'll do it in a while, DTAA part. No doubts? Okay. Now, interest, royalties, fees for technical services deemed to accrue or arise in India. Now, payee should be a non-resident, because for resident, we know its global income is taxable. This is what we are talking about. This deemed to accrue concept is only for non-resident, right? We are putting a source kind of, we are creating a source for the non-resident, that this is the source and this income is arising in India or deemed to be said to be accruing in India, right? So we are talking about payee who is non-resident, who is the recipient of income. Payer who is carrying on the business or profession in India and having the source of income in India. Payer. Now, who could be the payer? We are talking about government, resident payer, and a non-resident payer. First, we'll talk about that, right? For government, whenever a government pays to non-resident, be it interest, be it royalties, be it fees for technical services, it will be always deemed to accrue or arise in India. For a government, it will always be said to be deemed to accrue or arise in India. So if, say, for example, government is borrowing from a foreign bank and is making the interest payment, it will be deemed to accrue or arise in India. Clear? Even if it may be for some project of government outside India. Clear? Still, it will be deemed to accrue or arise in India. Whenever the payments are made by Government of India in respect of interest, royalties, or fees for technical services, it will be deemed to accrue or arise in India. In case of resident payer, payer who is resident of India, in that particular case, if the payment is made to a non-resident in respect of business or profession carried on by that resident in India, income will be deemed to accrue or arise in India in the hands of non-resident. So say, for example, tomorrow I'll be making a payment to an architect outside India for designing my office in India, right? In that case, the payment will be deemed to accrue or arise in India in the case of that architect. We are determining whose income? Architect's income. Architect is a non-resident. Say architect is of London. In that case, if I am making the payment for developing my office, in that case, that payment will be deemed to accrue or arise in India in the hands of that non-resident architect. Clear? Third, if, say, for example, there is an exception to that. There is an exception to that. If, say, for example, I want to establish my office in London. I want to establish my office in London. Now I am hiring an architect in London or an interior designer in London. In that case, though I am resident, but the income will not be deemed to accrue or arise in India because it is in respect of my business or profession carried on outside India. Because this is in respect of my business or profession carried on outside India. Are you clear? In case of a non-resident payer, in case of a non-resident payer making payment to another non-resident, the payment will be deemed to accrue or arise in India if that non-resident carries on the business or profession in India. What do I mean by that? So say, for example, there is a foreign company A. It is making interest payment to a foreign bank. It is making interest payment to foreign bank on loan obtained from that foreign bank. For starting the operations in India, for starting a branch in India, in that case, the interest paid by a foreign company to the foreign bank will be deemed to accrue or arise in India. Clear? Will be deemed to accrue or arise in India. Are you clear up till now? Any doubts? Any doubts? Ambika, I didn't get your doubt properly. Foreign company having poem in India paying dividend. Can you elaborate? Any other doubts? No, Raghuram, no threshold limit is applicable when salary, dividend, interest, royalties are paid to non-resident. No thresholds. Okay. No further doubts? Now, the income of the non-resident. The income of the non-resident shall be deemed to accrue or arise in India, irrespective of the fact that non-resident does not have the place of business in India. I am talking about the person who is receiving the income, not the person who is paying the income. The payer should have a place of business in India. The payer non-resident should have a place of business in India, as in it should be for his business operations in India. He may not have place of business, but it should be in respect of business operations in India, the payer. But payee may not have any business in India. Payee may not have any presence in India. Payee may not have any connection in India. But if he is receiving payment from a resident or from a non-resident in respect of his operations carried out in India, then in that case, the income will be deemed to accrue or arise in India. Also, the Act says that irrespective of the fact that non-resident has come and rendered the services in India, the service provider I am talking about, the service provider who is a non-resident, even if he has not rendered the services in India, but the payment has been made by a resident or government or a non-resident in respect of his operations in India, still the payment would be deemed to accrue or arise in India. What do I mean by that? So say, for example, if a person who is resident in India is making payment to a non-resident in respect of the services utilized in India, right? In respect of the services utilized in India. What do I mean by that? So say, for example, there is a concept of offshore services and onshore services. What is this concept? So a non-resident may say supply the machinery. A non-resident may supply the machinery, right? He may also provide some installation services. He may also provide some installation services, right? He may design the machinery also for me, specifically for me, right? Now he has provided designing services. He has supplied the machinery, and later on, when the machinery gets delivered in India, the installation also happens. Now, installation is happening in India. That is an onshore service. That is something his employees may be coming and getting the machine installed in my premises. No doubt, the installation of machinery, the payment which will be made against that would be income deemed to accrue or arise in India, right? Because services are also rendered in India. But with respect to sale of machinery and with respect to designing charges, right? Now, sale of machinery would get taxed under 911 business connection. It is not FTS. It is not interest. It is not royalty. Sale of machinery is falling under business connection. Correct? So only when he will have a business connection, it will be taxable under 911. Right? But designing charges, that may fall under fees for technical services. Now, non-resident would say, I have not rendered the services in India. Meaning what? I have not come down to India to provide you that service of designing the machinery. I have done it from outside India only. Act says, doesn't matter. If a resident person is paying you in respect of his business carried on in India, it will be taxable in India. The services are utilized in India. So whether or not it has been rendered in India doesn't matter. Is it clear? Is it clear? Any doubts? No, Ambika, it will be considered a domestic company in that case. If it is paying dividend, if it is declaring the dividend in India and it's making arrangements for the payment thereon, it will be domestic company in that particular case, Ambika. Yes, Ankush, 115 BBDA has lost its relevance. Venkat, interest paid on loan from a foreign bank for starting business in India has a connection with India. You are utilizing that loan for doing business in India, and therefore, if a non-resident is making payment for that interest, it will be for income deemed to accrue or arise in India. Clear, Venkat? Okay. So now coming to the specific points under interest, royalties, and fees for technical services. First of all, interest. Now, interest, as I said, it can be paid on the loan which is obtained from a foreign bank, but it should be for business carried on in India. Clear? Now, there is an important circular which has come up, and which is with regard to PE making payment to the head office. What is PE? PE is permanent establishment. Permanent establishment, you can understand it as branch. We see it in a while what is permanent establishment in a great detail. But for now, understand PE, permanent establishment, as a branch of a foreign company. As a branch of foreign company. So say for example, this is the head office, which is a non-resident, right? Head office, say a bank. Say as, put it as Citibank, New York. Okay. It has a Mumbai branch. Now, as you know, these banks provide the loans to its branches for the internal functioning, because this is the main business of the banks, right? So in that particular case, if say for example, the Citibank Indian branch makes the payment of interest to the head office, whether that interest would be deemed to accrue or arise in India. Why this particular question has been, put into picture? Because a branch and head office is technically a part of the same business unit. It's not a separate entity. Branch is the same entity. So branch is part of that particular same company. It's not a separate entity in itself. It's not a subsidiary. It's a branch. So if I make the payment it's like payment from one pocket to another pocket, right? So interest is getting paid by the Indian branch to that head office, right? So the question here arises whether the deduction would be allowed to the branch and whether it will also be taxable in the hands of the HO. So CBDT has come out with a circular against that. What does it say? CBDT has clarified that branch of a foreign company in India is a separate entity for the purpose of taxation under the Act. So though it is a same unit, but for the purpose of Act, it will be treated as a separate entity. And accordingly, TDS provisions would apply along with separate taxation of interest paid to head office or other branches of non-resident, which would be chargeable to tax in India. So when the branch is making payment to head office, the interest would be chargeable to tax, and TDS also would apply. If the branch fails to deduct the TDS, then in that case, disallowance would be made. Clear? So interest paid by the PE to the head office is an interest payment sourced in India and is liable to be taxed under the source rule in India. Clear? And therefore, this particular circular was not followed in many of the judicial decisions, and therefore 915 was expressly amended. What does it say now? 915. Assessee is a non-resident and is engaged in the business of banking. Interest is payable by the permanent establishment or a branch in India of such non-resident to the head office or to any other branches of such non-resident outside India. Any interest payable by the permanent establishment or a branch of such non-resident outside India shall be deemed to accrue or arise in India and shall be chargeable to tax in addition to any income attributable to that branch. So that will be chargeable to tax in India. That interest payment which is being paid by the PE to the head office would be chargeable to tax in India. And permanent establishment in India shall be deemed to be a person separate and independent of the non-resident person. Clear? It will be treated as separate and independent person. Accordingly, the PE in India shall be obligated to deduct the tax at source on any interest payable to the head office. Clear? Is it clear? Any doubts till now? So this is only in respect of the banking companies. This is not applicable for every branch and head office. Clear? Okay, Raghuram, I'll explain again design charges. $115 BBD is not applicable, Ankush, now. Now, entire dividend is any which way taxed in the hands of shareholder. Clear, Ankush? So, Raghuram, I said for designing charges that the designing charges are the services which were rendered outside India. So, non-residents never came into India to provide that services. But since the payment is being made by the Indian resident, in that case, even if the non-resident has not rendered the services in India, but since the services are utilized in India, it will be said to be deemed to accrue or arise in India. Clear, Raghuram? Is it clear, Raghuram? Any other doubt? Venkat, we have been solving sums and we would be solving more case studies on this fees for technical services also. Don't worry. Okay. So let's move further. Now I'll move to royalty. So the term royalty has been defined. It means consideration, including any lump sum consideration, but excluding something which is chargeable under the capital gain. What will be chargeable under the capital gain? The sale of asset itself, right? The sale of where the entire consideration is received for the rights which are transferred or the intangibles which get transferred. Clear? So excluding that, it includes the consideration for transfer of all or any rights, including the granting of license in respect of a patent, invention, model, design, secret formula or process or trademark or similar property. So what is royalty? It includes the consideration where rights are transferred or the license is transferred to use a patent, right? Invention, model, design, secret formula or process. So say for example, if a drug has been developed outside India, right? And the license is granted for that drug to Indian company to produce that drug, right? Generally, the patents are granted for the patents are obtained for the drug, and then that process is shared with the other companies so that they could produce the same drug, which is happening, say, for COVID, right? In that particular case, the payment which has been made for that particular process, the license which has been obtained for that, to use that process, then in that particular case, it will be considered as royalty. Clear? So, transfer of all or any rights in respect of a patent, invention. Say, for example, some invention has been made, and I am taking the license to produce or use that kind of invention, then in that case, it will be considered as royalty. Say some designs have been produced, right? And a license has been obtained for that. Clear? So a right is given to me to make those designs, to reproduce those designs. Then in that particular case, it will be considered as royalty. Clear? Imparting of any information concerning the working of or the use of patent, invention, model, design, secret formula or process or trademark or similar property. So if any information is granted, if any information is imparted as to how this particular invention or design has been developed, so that I can also develop it on my own. So if any information is provided, then in that particular case, so if any consideration is paid towards that kind of information which has been provided by a non-resident, it will be considered as royalty. Use of any patent, invention, model, design, secret formula or process. So say, for example, in the first case, there was transfer of rights in respect of a patent. In the third case, it is saying the use of patent. So in the first case, there were rights given in that patent, right? And in the third case, just a use has been given. Use of any model, use of any design, use of any process or trademark. Say, for example, there are these franchisees who use that trademark, right? So in that particular case, whatever the franchisee fees which are being paid, the payment which is made towards the use of that trademark would be considered as royalty. Clear? Imparting of any information concerning technical, industrial, commercial or scientific knowledge, experience or skill. So if any information has been provided, which is technical in nature, which is scientific in nature, in that case, that would be considered as royalty. The payments would be considered as royalty payments. Clear? Use or right to use any industrial, commercial or scientific equipment. Say, for example, a machinery lease has been given. That would be considered as royalty. Or for example, some scientific equipment is given on lease. So in that case, it will be considered as royalty payment. Clear? Transfer of all or any rights in respect of any copyright, literary, artistic or scientific work, including films or videotapes for use in connection with the television or tapes for use in connection with radio broadcasting. So if the rights has been transferred in respect of a copyright, in respect of, say, any artistic or scientific work which has been generated, say, for example, movies, in that particular case, it will be considered as royalties. So earlier, this was excluded. What was excluded? Sale, distribution or exhibition of cinematographic films. This was excluded from royalty definition. But since 2020 Finance Act, this is also now included. This exclusion has been deleted, so it get included. Clear? So this is the definition of royalty, which is very, very wide under the act which is provided. I'll also discuss more, but do you have any doubts till now? Any doubts? Okay. Now, understand one thing. Here, if we say transfer of all or any rights in respect of any copyright, right, and not a copyrighted product. Now, what is the difference between copyright and copyrighted product? So, there has been quite a lot of litigation around the use of transfer of rights in a copyright with respect to the computer software. With respect to the computer software. Now, these software products, they are categorized, whether they are categorized as copyright or a copyrighted article. So, for example, you have this Tele ERP software. You get that license of Tele ERP and you install it in your computer. The question arises, the payment which you are making is for the product or it is a copyright you are getting. So there had been views on both the sides. Some say it is a product which I am getting. So a CD comes, I install it in my computer and I use that license. Some say, so therefore they say it is a royalty. But some say it is not a royalty because the license which I am getting is very restricted license. I cannot reproduce the Tele copies and sell it in the market. I can only use it on my PC, right? I cannot reproduce it. So the license which I am getting is a product. It's a copyrighted article and not a copyright. Copyright, if I get, I can reproduce it. Since I cannot reproduce it, it's not a royalty. But Section 916 has now put an end to this litigation and it says that even the computer software will fall under the royalties. Let's see that. So consideration for use or right to use of a computer software is royalty within the meaning of Section 916. Consideration for use or right to use of the computer software is a royalty under Section 916. What does it say? An transfer of all or any rights in respect of any property, right or information includes and is always included. They have made this a retrospective amendment. Use the right to use a computer software, irrespective of the medium through which such right is transferred. Clear? So now computer software has also been specifically included under the definition of royalties. Is it clear? Is it clear this much? But there is an important CBDT notification which says that which exempts certain software payments from the applicability of tax deduction under Section 194J. What is that? So where a payment is made for acquisition of software from a resident transferor, 194J will not be attracted if the software is acquired in a subsequent transfer without any modification. What does it mean? So say for example, I have purchased that software, I sell it to you. So in that case, in the second transaction, so let me make you understand. So say for example, this is person A, this is person B, and this is person C. So this notification says that if person B is selling the software to C and when C is making the payment, no TDS will arise on this transaction. If a software was purchased from A and sold it without modification directly to C, and the tax was deducted in this particular case, TDS was deducted under Section 194J or under Section 195 in this particular case, then no TDS will be deducted in the second sale if there has been no modification. So this has been a CBDT notification. Clear? Clear? Any doubts? Any doubts? Okay. Next important point under royalty is payment for lease space segment in a satellite or a transponder. Now, what is this? So let's understand this. So say, for example, there's this Indian company who is making the payment to a foreign company for space in satellite. Now, why are these payments made? Because you know that there are some channels, or say for example, there are some of these sports matches, which are cricket matches, which are held outside India. Their broadcasting happens in India, right? So you are getting the direct view of that match, which is happening outside India on your TV. So these satellites are installed, right? So if the space is obtained on that satellite to do a broadcasting, then in that particular case, if the payments are made by Indian company to the foreign company in respect of usage of that space on satellite, the question arises whether that payment would be chargeable to tax as royalty. That is the question, right? So in that particular case, what does this section 915 says that? Let's see. It says royalty includes consideration for use or right to use any industrial, commercial or scientific equipment. Clear? The argument against that was that this satellite has not been leased by me. I do not have any possession of this satellite. Right? When you say that a right to use has been granted, I should get the possession. But I do not have any possession of this satellite, right? In that particular case, explanation 5 was specifically introduced to clarify that royalty includes consideration in respect of any right, property or information, whether or not the possession or control of such right or property is with the payer. Such right, property or information is used directly by the payer. The location of such right, property or information is in India. So whether or not the property is in India, whether or not there is a possession of that property, and whether or not that I have the right to use that property, still if a payment is made for lease space segment in a satellite or transponder, it will be taxable in India. It will be characterized as royalty deemed to accrue or arise in India. Clear? Is it clear? Any doubts? Any particular doubts? Any doubts? Gomati, this is non-resident. Are you clear with this concept? Okay. So let's move further. The third point which is arising in royalties, supply of software embedded in hardware. So when a hardware is sold and in that there is some software which is installed, whether in that case it will be considered as royalty. So this was a case which was before the High Court, and the High Court answered that software embedded in hardware does not have an independent existence and use. The software was integral part of the hardware. So this was basically with respect to the GSM mobile telephones. That telephone is a hardware, and in that there is some software which is installed. So whether the payment would be regarded as being paid for software royalty. So the court said that consideration for supply of software embedded in hardware is not royalty, because software is an integral component of hardware only and it cannot be segregated. Clear? Then these are the issues which I discussed with you with regard to royalty. Now, how is the taxability of royalty under the Act? For a non-resident, if there is a PE in India, if there is a branch in India, then it is taxed at the rate of 40% on net basis. If there is no PE, it is taxed on gross basis. Gross basis meaning that no deductions will be allowed, no deduction of any expenditure, no deductions under Chapter 6A will be allowed, and it will be taxable at the rate of 10%. Clear? In case of resident, royalty is taxable under Section 115 BBF on gross basis. What is 115 BBF? We'll look into now. But this is the taxability of royalty. Clear? What is 115 BBF? Concessional taxation regime in respect of royalty income in respect of patent developed and registered in India. So this had been started, I think, in 2016. This scheme was introduced. A concessional tax regime was introduced to promote the registration and development of the patents and technology in India. So this is available only to a resident in India who is the true and first inventor of any invention and who registers the patent in India. And he incurs at least 75% of the expenditure. In that case, royalty will be taxable at the rate of 10% on gross basis plus surcharge and cess. No reduction of any expenditure will be allowed. MAT also will not apply on such income. And the assessee has an option to apply for this 10% rate, 10% gross basis. This option is to be exercised before the due date under Section 139(1). So before the due date of filing of ITR, you have to exercise this option. Once you opt for this scheme, and suppose in the next year you do not offer in accordance with this scheme, then in that particular case, for the next 5 assessment years, you cannot again opt in for this particular scheme. Clear? So this is Section 115 BBF. It is specifically applicable for the resident person. Clear? Any doubts? Any doubts? Okay. So I move towards fees for technical services. Now, what is fees for technical services? Fees for technical services means any consideration for rendering of any managerial, technical or consultancy services. What is managerial, technical and consultancy is not defined under the Act. It just says it is fees for consideration received for providing managerial, technical and consultancy services, and includes the provision of services of technical personnel or other personnel. All right. So it includes the services by way of provision of technical personnel. If some employees are sent providing some technical information on a contract basis, so that will also get covered. The payment against that will also get covered under fees for technical services, but excludes consideration for construction, assembly, mining and salaries. Clear? Now, how is the taxability of FTS under the Act? Same as royalties. 40% if there is a P on net basis, 10% if there is no P on gross basis. Clear? Now, there are some issues again in respect of fees for technical services also, because these terms are not defined. What is managerial, technical and consultancy is not defined. So there were questions asked before the court that whether the standardized services, say for example the interconnect charges to a mobile operator or some standard facilities wherein they are provided, right? So in that particular case, whether that will be considered as the fees for technical services. So those were the questions before the codes which have been asked. So what are the interconnect charges? These are the fees that one telecom company pays to another telecom company, right? When the calls are getting connected. So these interconnect charges, whether these are fees for technical services, in this particular case, the court said that the interconnect charges paid to a mobile operator is not a technical service. Why it is not a technical service? Because in that case, it was said that technical means not the proper, in technical does not mean in the proper sense that it should be of a technical nature, but there should be some human involvement, because technical derives its meaning from the words it is joined with, which are the words managerial and consultancy. So if you see, managerial and consultancy involves an human involvement, right? So similarly, the court said that technical also should have some amount of human involvement, some amount of human presence. So mere standardized services without human involvement will not amount to the technical services. Clear? So what do we mean by technical services? That there should be some human involvement. So where, say for example, internet bandwidth charges, where there is no technical, no human involvement, these kind of services cannot be regarded as technical services. Clear? Is it clear? Any doubts? Any doubts? Okay. Then there is important recent Supreme Court decision, which was in the case of AP Mola Maersk. Which was in the case of AP Mola Maersk. So what was this case? In this particular case, some amounts, so a software was developed by a company, and this company was engaged in shipping business. This company had some agents in India. So while this software was being developed, this software, once it was developed, it was provided to all the agents, and it was an integrated communication system. So for the agents across the world, this particular software was developed, which helps the agent to enter the information with respect to their operations. Now, the payment for that particular software was made by all the agents to the company. What was the payment? So the software cost, the development cost which was there, that particular cost was being paid to the company because that cost was shared amongst all the agents. So the question came up before the Supreme Court that whether these payments which are being made to that company by the agents are in the nature of fees for technical services, or they are in the nature of reimbursement of expenses. That was the question before the Supreme Court. The Supreme Court said that this was in the nature of reimbursement of services because it was a standard facility granted by the company to its agent for its business operation. It was not something, a specialized service which was developed for these agents, right? So it said that the payments are not in the nature of some specialized service, and therefore they do not amount to technical services. Clear? It was only a standardized facility that was allowed to be shared by all the agents. Clear? So this was a very important decision which was rendered by Supreme Court. Any doubts? Then we have some special tax rates on income from royalties, FTS and interest. I already told you about royalties and FTS. What is the tax rate? 10% on the gross basis. For dividends to a non-resident, it is taxable at the rate of 20%. It is taxable at the rate of 20%. Interest received from government or an Indian concern on monies borrowed or debt incurred by the government or Indian concern in foreign currency, it is 20%. So interest received from government or an Indian concern on money borrowed or debt incurred by the government or Indian concern, it's 20%. Interest received from an infrastructure debt fund, it is 5%. Then interest referred to under section 194 LC received from an Indian company or a business trust in respect of money borrowed by an Indian company under a loan agreement by way of issue of long-term bonds, it is 5%. Or in respect of monies borrowed from sources outside India by way of rupee denominated bond, it's 5%. So if it is in respect of rupee denominated bond, it is 5%. If it is in respect of infrastructure debt fund, it is 5%. If it is a normal interest received from government or Indian concern, it is 20%. Clear? Interest to the FIIs, to the foreign institutional investor in respect of rupee denominated bond or government security, again it's 5%. Clear? Then distributed income being the interest income of a business trust from a special purpose vehicle to non-resident unit holders, it is 5%. This all you will learn in great detail when you will have lectures on this trust, this business trust particular provision. Distributed income being dividend income of a business trust from a SPV, 10%. And income received in respect of units purchased in foreign currency of a mutual fund, it is 20%. Clear? Is it clear? Any doubts do you have? You can ask me till now. So all these particular tax rates which are there, they are all on the gross basis. No deductions would be allowed against that, and no expenditure deductions would be allowed against that, except in the case of IFSC, where a deduction under 80LA is allowed. Now, the important question which arises is whether an assessee is required to furnish a return of income when the total income consists of interest, dividend, royalties, or fees for technical services. Which assessee? A non-resident assessee. So this 115A section provides that where the total income consists of only interest, dividend, royalty, or fees for technical services, and tax has been deducted on such income, then in that case, no return of income is required to be furnished. Clear? If the tax has been deducted at this particular rate, then no income tax return is required to be furnished if the return has only these kind of income: interest, dividend, royalties, or fees for technical service. Clear? If you have any doubt, please ask me. Otherwise, we'll solve few case studies based on this FTS. Any doubts? Okay, so let me put forth some case studies so that you have a little better understanding. One second. So tell me the answer for this. Write down. Xylo Inc., a US company, received, all right, did not have PE in India. It entered into an agreement for execution of electrical work in India. Separate payments were made towards drawings and designs. As engineering fee. The assessee contended such profits shall be taxable in US as there is no business connection as per section 911. What do you think? Whether the contention of the assessee is correct? What do you think in this case? Whether the contention of assessee is correct? Quickly tell me in the chat boxes. Very quickly. Whether the contention of assessee is correct? Yes, Ambika, perfect. It will be taxable under which part, Ambika? Taxable as? Please quickly tell me. Whether the contention of assessee is correct or not. Perfect, Venkat. But which part it will be taxable, Venkat? Ambika, that's a TDS provision. But I'm asking like whether royalty, interest, FTS, what is it taxable as? 9156, what? 7. Kunal, by? So here SSE is not correct because this will be taxable as fees for technical services. These are engineering fees paid and your business connection section will not apply. Clear? Second question. Give me your answers very quickly because these are very simple and small questions. No computations also. Second. A firm of solicitors in Mumbai engaged a barrister in UK for arguing a case before Supreme Court of India. Payment of £5,000 was made. Quickly, in 1 minute, you have to tell me the answer. Less than that. Yes, Ambika, perfect. What about this answer? Which particular provision it will fall into? Business connection, FTS, royalty, fast. Whether it is taxable as royalty, FTS. Fast, fast, fast. Yes, Ambika, but what? Like FTS, royalty, business connection. Yes, but Venkat, in which section? Very quickly. So this will be taxable under section 911 because business includes a profession, right? So these are professional services which are being paid and this will be taxable as under section 911 business connection. Clear? Clear? Next question. A company in Australia has entered into an agreement with an Indian company for rendering technical services to a foreign company for setting up a fertilizer plant in Odisha. As per the agreement, foreign company rendered onshore and offshore services to Indian company for fees of rupees 1 crore and 1.5 crore respectively. Foreign companies of the view that it is not liable to tax in respect of fee of rupees 1 crore. Sorry, 1.5 crore. Then it is not liable to tax in respect of rupees 1.5 crore. What will be your answer? Whether foreign company is correct? Quickly. Whether foreign company is correct? What will be the answer? Yes, Ambika, correct. Yes, Venkat. Right, Deepa. So in this case, onshore as well as offshore will be taxable, because what I said to you, that irrespective of the fact that whether or not the services are rendered in India, it will be taxable as fees for technical services in India, because the services are utilized in India. Are you clear? Are you clear? Any doubts till now? Any doubts? You can ask me any doubt, or there, or otherwise we proceed towards the other particular section. Perfect, Raghuram. Any doubts do you have? Do you want me to solve few more sums of FPS, or we move ahead to next section? Venkat, I told you permanent establishment is a branch. For now, you understand it's a branch. I'll discuss with you in detail in a few minutes time what is a permanent establishment. Okay, Venkat? Any other doubt with respect to royalty, fees for technical service, interest, any concept you did not understand? Or if you want me to take a few more questions on that? Okay, Ambika and Raghuram. I'll give you one more question on FTS. Xylo Inc., a US company, received income by way of fees for technical service of rupees 2 crore from ABC Limited Indian company. From ABC Limited, an Indian company. Expenses incurred rupees 8 lakhs. Expenses incurred rupees 8 lakhs. Xylo Inc. has a PE in India in respect of which technical services are effectively connected. So FTS 2 crore, expenses 8 lakh, fees for technical services from other Indian company 4 crore, expenses incurred for that 15 lakh, expenses not wholly and exclusively incurred for business of such P 6 lakh, amount paid by P to HO not being in nature of reimbursement of expenses 12 lakhs. You are required to compute the income of Xylo. Quickly tell me your answers in chat boxes. Income. What will be the income of Xylo? No Venkat. No Raghuram. Very close, Ambika. I think you have made a very small mistake somewhere. So in which section the income will be computed? Whether it will be under 115A or 44DA. Here there is a permanent establishment in respect of which the fees for technical services are connected, right? So in this particular case, 44 DA will apply. 44 DA will apply, right? So once 44 DA is applicable, it will be taxable on net basis. So what is your income first of all? 2 crore plus 4 crore. This is your income. What is your expenses? 23 lakh. 8 lakh plus 15 lakh, right? 8 lakh plus 15 lakh. Whether expenditure not wholly and exclusively incurred for the business of such fee will be included? The answer is no. Only expenditure which are incurred for the purpose of permanent establishment, only those expenditure would be allowed. Not, which are not wholly and exclusively for P, that will not be allowed. Clear? Whether amount paid by P to HO will be allowed? Answer is no. Only if the amount is in the nature of reimbursement of expenses, only then it gets allowed. Right? Otherwise, it doesn't get allowed. So your income would be 5 crore 77 lakh. Clear? Is it clear? Any doubts? Did you get this sum? Should we take a small break? Yes, Ambika, I told you it's a very small mistake. I think you have made it. So we take a 5-10 minutes break and we'll get back. Yeah. So any doubts do you have now? Any doubt? I'll give you one more question on this. One last question. But you have to quickly tell me the answer. It's a past exam question. Let's look at it together. Okay. So Red Limited, a non-resident foreign company, had entered into a collaboration agreement approved by central government with Blue Limited, an Indian company, on February 21st, 2003, and is in the receipt of the following payments. Interest on 8% debentures for rupees 40 lakhs issued by Blue Limited in consideration of providing of technical know-how, manufacturing process and designs. Service charges at the rate of 2.5% of the value of plant and machinery for 500 lakhs leased out to Blue Limited payable each year before March 31st. Apart from above, Red Limited received a long-term capital gain amounting to 1.9 lakh on sale of debentures of an Indian company subscribed in US dollar. Compute the total income of Red Limited and determine its tax liability. So first of all, tell me for interest payment and these debentures, whether that will be taxable in India and what will be the tax rate. Quickly, one by one. For the first income category, tell me whether it will be taxable in India. And what will be the tax rate in that case? Whether it will be taxable and what will be the tax rate. Ambika, you're talking about interest. The tax rate is wrong, Ambika. Just read that point clearly. Yes, Raghuram, right. But what will be tax rate, Raghuram? Deepa, no, wrong tax rate. Your answer is correct, but you are missing one very important point. So see, here first is they are saying interest on 8% debentures for rupees 40 lakhs issued by Blue Limited in consideration of providing technical know-how. So apart from interest, there is this technical know-how being provided against which debentures are issued. So that Debentures are consideration paid for providing technical know-how. So first of all, 40 lakhs would be fees for technical services. Before interest, you have fees for technical services. Are you understanding that? Before interest, you have fees for technical services, which will be chargeable to tax at the rate of 10%. Clear? Then comes the interest on 8% debentures. Then comes the interest on 8% debentures. So that will be taxable 40 lakhs into 8% from July 1st to March 31st for 9 months. Right? So that will be your interest amount. And that will not be taxable at 20%. It will be taxable at the rate of 40%. So you will have fees for technical services at the rate of 10%, 40 lakhs. Interest at the rate of 40%, 40 lakhs into 8% for 9 months. Why 40% and why not 20%? If you see, it says interest received from Indian concern on monies borrowed by the Indian concern in foreign currency. In foreign currency. Right? But whether here it is in foreign currency, the answer is no. So therefore, 40% tax rate would apply and not 20%. This was not in foreign currency. Are you clear? Are you clear? Then third, service charges at the rate of 2.5% on 500 lakhs will apply. Right? That will be taxable as royalties. Service charges 500 lakhs into 2.5% because it was for plant and machinery, commercial equipment, industrial, commercial and scientific equipment. Clear? That is again taxable at the rate of 10%. Then long-term capital gain amounting to 1.90 lakh on sale of debentures of Indian company. Long-term capital gain, that will be taxable at the rate of what percent? Long-term capital gain are taxable at what percent? Perfect, Harish. Those who gave the answer, interest 20%. Did you get why it's not 20%? Raghuram, are you telling me for long-term capital gain? What will be the tax rate of long-term capital gain? It will be 20%. Assuming it's a listed, it will be 20%. Clear? No, Raghuram. For shares, listed shares, it's 10%. Otherwise, it's 20%. So this will be at the rate of 20% if it is listed. If it is unlisted, if we assume it as unlisted, then it will be 10%. Clear? Clear? Any doubts with respect to this sum? Did you get this sum properly? Any doubts? Okay. So let's proceed further now to the next part. gift of money from resident to non-resident. Now again, this has been very recent introduction of 2019. Gift of money from resident to non-resident. So income which is arising outside India through any sum of money paid without consideration by an Indian resident person to a non-corporate, non-resident or a foreign company on or after 5th July 2019 would be deemed to accrue or arise in India if the same is chargeable to tax under section 56(2)(10). That is, if it exceeds rupees 50,000 and if it is not paid to a relative. So what was happening was, Indian person was going outside India, he was gifting the cash to a non-resident person and that was never taxable in India. So therefore this provision has been introduced to capture such kind of transaction. Clear? So what could be the example of this? So say for example, what will be the examples of this? See, gift of rupees, say 10 lakhs, NEFT transfer. You have to tell me that whether it is taxable or not. NEFT transfer from SBI account, to a friend's account in New York. Whether this will be covered under this particular category, whether this will get covered, answer is yes. So gift of money which is there will get covered in this, because what it says is income arising outside India being any sum of money paid without consideration by an Indian person to a non-corporate, non-resident would be deemed to accrue or arise in India if the same is chargeable to tax under section 56(2)(10). Is it clear? Is it clear? So this will be covered under section 918. Clear? Second, say for example, gift of rupees 1 lakh to a friend in Australia when Mr. A visited to Australia. Would that get covered? The answer is yes. That would also get covered under section 918. Clear? What will not be covered is gift of, say, shares, jewelry. All of that will not get covered because this particular section covers only gift of money. Okay, is it clear? So this particular section only covers gift of money. It doesn't cover all other gifts which are being given, like paintings, jewelry, work of art. All that will not get covered here. Clear? Any doubt? Any doubt? So this section is clear? Okay. Let's move to next section. Presence of eligible fund manager in India not to constitute business connection in India of such eligible fund and investment fund on behalf of which he undertakes fund management activity. So what is this section? So there are these fund managers which are appointed by the non-resident to manage their shares and investments in India. So usually what happens is the presence of the fund manager in India of a non-resident could create a business connection in India, despite that fund manager being an independent person. And if business connection is created in India, then the profits made by a fund outside India may be liable to tax in India. Also, there is a possibility that that fund may be treated as a resident in India based on the conclusion that the fund managers are managing the activity from India, right? So to avoid that, section 9A has been introduced, wherein they say that eligible fund manager undertaking this fund management activity, eligible fund management activity, would not constitute a business connection in India. Would not constitute a business connection in India. So they have given the criteria that the tax liability in respect of income arising to a fund from investment in India would be tax neutral, whether the investment is made directly or through the fund manager located in India. Would be neutral whether they make it directly. So then business connection would not constitute be just on the basis that there is a fund manager in India. Clear? So there are guidelines given like who are eligible funds. Fund should not be resident in India. Fund should be of a country with which India has a double tax avoidance agreement. Then they have given the guidelines for monthly average of corpus of the fund. And they have given guidelines that how much the percentage of the corpus should be held. So all that guidelines are given for the eligible fund and eligible fund manager. Clear? And if these guidelines are fulfilled, then the fund manager would not lead to a business connection in India of a non-resident fund. Clear? Then quickly moving to the next section, exempt income for non-resident. There are certain income which are exempt. I have given the list here. So you can just have a look through it because there are too many sections which provide for different exemptions in case of non-resident, like interest on money standing to the credit in a non-resident external account. There are these accounts which are there specifically for non-resident, and if the interest is received on that, then that interest would not be taken into consideration. It will be considered as exempt. Then there are different exemptions which are given specifically for non-resident. I have given the table here. So I need not explain all of that because it's self-explanatory in a way. I'll just quickly go to the next section then in that case. Okay, so this has been a recent introduction then. Certain income of a wholly owned subsidiary of Abu Dhabi Investment Authority, Sovereign Wealth Fund and Specified Pension Fund. Any income of a specified person in the nature of dividend, interest or long-term capital gains arising from investment made by it in India, whether in the form of debt or share capital, would be exempt in case of this wholly owned subsidiary of Abu Dhabi Investment Authority. So this has been a specific exemption granted to this Abu Dhabi Investment Authority sovereign wealth funds, which are coming especially from UAE. And if they invest in this business trust or a company operating in maintaining infrastructure facilities or AIF, then that investment income would be exempted. So that's just a new section which has been introduced. Clear? Then I'll quickly come to the very important section, the computation of capital gain for non-residents. If you have any doubt till now, you can ask me, or otherwise we move to this very important provision in case of capital gains for the non-resident. If you have any doubt, you can ask me now. Otherwise, we move towards it. Any doubts? Okay. So we move towards this very important section, capital gain for the non-resident. Now, usually when we compute the capital gains for the non-residents who invest in foreign exchange, they are given this exchange fluctuation benefit because they invest in this foreign currency. So to give them this protection against the exchange currency fluctuation, they are given the benefit of that. The benefit of currency fluctuation, they are given the benefit of that. Now, when does this benefit happen? So there are these certain conditions, and instead of giving them this indexation benefit, this particular benefit is granted to them. So this particular provision is mandatory for them to be, opt for it, and they are given this particular benefit wherein this currency exchange fluctuation is given to them. So what is this? If, say for example, a non-resident invests in foreign exchange to acquire the capital assets, first proviso to section 48 provides that capital gains arising from the transfer of shares or debentures of an Indian company. So it applies on shares or debentures of an Indian company, right? So shares or debentures of Indian company, the capital gain would be computed as follows. Cost of acquisition, expenditure incurred wholly and exclusively in connection with the transfer, full value of consideration are to be converted into the same foreign currency in which the shares were acquired. So all the cost of acquisition, expenditure on transfer, full value of consideration have to be converted to the foreign currency in which they were acquired. And the resultant capital gains which are derived will be then converted into Indian currency. Clear? So this capital gain shall be applied for every purchase and sale of shares and debentures of an Indian company. And you will not receive the indexation benefit because you are receiving this exchange currency fluctuation benefit. Clear? Now Rule 115A provides for the exchange rate, how to compute the exchange rate, how to convert it to the foreign currency and then reconvert it to Indian currency. So cost of acquisition of capital asset would be converted as on the exchange rate as on the date of acquisition of capital asset. What will be the exchange rate? It will be the average of telegraphic transfer buying rate and telegraphic transfer selling rate of the foreign currency initially utilized in the purchase of capital asset. Clear? Telegraphic transfer buying rate, TTBR, and TTSR, the average of that will be taken for the cost of acquisition as on the date of acquisition of asset. For expenditure as on the date of transfer of asset. For full value of consideration as on the date of transfer of asset. Right? So once you derive the capital gain in foreign currency, you will reconvert it into the Indian currency as on the date of the transfer of capital asset. And for that, you will only use telegraphic transfer buying rate. Clear? So you will use telegraphic transfer buying rate for reconverting the capital gain into the Indian currency. Clear? So we'll solve a sum on this and then you should have an idea. I'll give you quickly a sum so that you get an idea on this. 1 second. Let's write together the sum on this. A non-resident purchases shares of Reliance Industry Limited as on 1/1/2030 by remitting US dollar. Following data is given. Cost of acquisition 5,85,000. Date of sale 1/1/2020. Sale price rupees 9 lakh. Date of expenditure on transfer 28/12/2019. Expenditure on transfer rupees 6,600. On 24th April 2020, rupees 6,15,000 was invested in shares of ICICI out of sale proceeds of rupees 9 lakh, which were sold on 31st December 2020 for rupees 10,50,000. Compute the capital gains. Compute capital gains. Exchange rates 1/1/2013 TTBR TTSR 38.40. 28/12/2019 42.44. 1/1/2020 39.41. 24th April 2020 40.42. 31st December 2020 41 and 43. How will you compute? So can you try once and then I'll solve? Yes, Raghuram, you're right. Mridula, I'll share it again. Don't worry. So how will we solve this sum? Let's understand together. See, sale price would be how much? Now we have to assume in the sum that Reliance Industry is not a listed company, because if it would have been a listed, then as per section 112A, first proviso is not applicable. Clear? Here we have to understand that it's all unlisted share. So sale price amount in rupees is 9 lakh. You have to convert it to foreign currency. So exchange rate would be what as on the date of transfer, TTBR and TTSR, right? What is the date of transfer? Date of transfer is 1/1/2020, right? So 39 plus 41, this I have to take. I have to take average of this, right? So 39 plus 41 divided by 2, clear, is equal to 40. Amount in dollar would come to 22,500. Clear? Less expense on transfer. What is expense on transfer? 6,600. I will convert it to TTBR and TTSR's average as on the date of transfer. So 39 plus 41 divided by 2 equal to 40, 165. Clear? Less. Cost of acquisition. Cost of acquisition. What is the cost of acquisition? 5,85,000. I have to reconvert it as on the date of purchase. As on the date of purchase, right? Which is this, right? So 38 plus 40 divided by 2 is equal to 39. So this comes to 15,000. So do you understand how do we have to compute? Right? So capital gain, this will be long-term capital gain, would be how much? 7,335. This is in dollars. Now you have to again reconvert it in Indian currency. So 7,335 into TTBR as on the date of transfer. What is the TTBR as on the date of transfer? 39. Right? Then we need not take average. So into 39, this will come to 286,065. 286,065. Are you clear? Did you understand this sum? Did you understand this sum? Any doubts? Did you get this sum properly? For ICICI Bank, it will be short-term capital gain, right? For ICICI Bank, how will you do? How will you do for ICICI Bank? So again, we will take into consideration the full value of consideration ICICI. How much is it? 10,50,000, right? And on which date the investment has been made? So this will be done for every reinvestment also. So first proviso to section 48 applies to capital gains arising from every reinvestment also. Clear? It applies to every reinvestment also. So it's not that the case that it will get over once the shares have been sold. It will also apply if the amount has been reinvested again in the shares. So it will also apply to ICICI share also. Clear? So in that particular case, what has been the date of transfer of ICICI shares? On 24th April. So we have to take 40, no, it has been sold on 31st December 2020, right? So 41 plus 43 divided by 2 we will have to do. Clear? For ICICI we have to do 41 plus 43 divided by 2 is equal to 42. 25,000. There is no expense on transfer. Cost of acquisition is 6,15,000, right? That is on 24th April 2020. So 40 plus 42 divided by 2. 15,000. This will be short-term capital gain, right? 10,000. And you have to again reconvert as on the TTBR as on date of transfer. Clear? Clear? So cost of acquisition, the TTBR and TTSR you have to take as on the date of reinvestment and not on the date of original purchase. Clear? Any doubt? Any doubts? Did you get this sum? Shall we proceed further? Did you get the first proviso to 48? Okay. So let me move further then, if there are no further doubts. Special provision for non-resident Indian. Now, these are some special provision which are applicable for non-resident Indians. Okay, which is provided under chapter 12A. Which is provided under chapter 12A. Now, here a concessional rate has been provided for investment income arising to a non-resident Indian. For investment income arising to a non-resident Indian. Clear? Now, in this particular, this is not applicable for every non-resident. This has been applicable only for a non-resident Indian, I am saying. So, what is this provision which says non-resident Indian who is a citizen of India or a person of Indian origin? A non-resident who is a citizen of India or a person of Indian origin, if he has investment income other than dividend referred to in 1150 and LTCG on assets other than specified assets, then in that case it will be 20%. LTCG on a specified asset, it will be 10%. So this has been a concessional rate provided to a non-resident Indian. Clear? Under section 115E, which is only to a non-resident Indian and not to every non-resident. Are you clear? Are you clear with this? So what is a specified asset? The specified asset means shares of an Indian company, debentures issued by an Indian company which is not a private company, deposits with Indian Public Limited Company. So all of this would be included in a specified asset, and specified asset should be purchased in a convertible foreign exchange. Should have been purchased in a convertible foreign exchange. Clear? So specified asset, I have given you the meaning, and this will be on the gross basis. Deductions will not be allowed under chapter 6A. No second proviso to section 48, meaning indexation benefit will not be available on this particular provision. Clear? Now, there is one more provision under this, apart from the tax rate, which is exemption under section 115F, which is similar to our section 54F. 54F allows for proportionate capital gains, which is reinvested in the asset. Similarly, on long-term capital gains, if you reinvest again in the specified asset within 6 months from the date of transfer, then LTCG into amount invested divided by net sale consideration will be allowed as exemption. Say for example, if the new asset is transferred or converted into money within its period of 3 years from the date of acquisition, then the exemption would be withdrawn and the exemption granted earlier shall be taxed as long-term capital gains of the previous year in which new asset is transferred. Now, to explain you just the last sum which we did, this particular question, right? In this case, say for example, here instead of a non-resident, this particular person would have been non-resident Indian. The computation would have remained the same. The computation would have remained the same because second proviso is not allowed to that person, but first proviso is still allowed, right? Now, in this case also, if you see, he is making a reinvestment in a specified asset, right? He is making a reinvestment in specified asset. Since he was non-resident, we did not allow him the exemption under section 115F. But if he becomes a non-resident Indian, then in that case, we will allow him the exemption. And how will you allow him the exemption under section 115F? How will you allow him the exemption under section 115F? You will take into consideration the capital gain. What was the capital gain in this particular case? 2,86,065. This was the long-term capital gain, right? So 2,86,065 into what is the net sale consideration? Sorry, what is the amount of investment which was made? Investment was made of 6,15,000, right? The reinvestment was made of 6,15,000. So 6,15,000 divided by the net sale consideration. What is the net sale consideration? 9 lakh minus 6,600, right? Sale price minus expenses on transfer. So net sale consideration comes to 8,93,400. So therefore, exemption of rupees 1,96,921 would have been allowed, and chargeable capital gain would have been 2,86,065 minus 196,921. Right? In that case, 89,144 would have been chargeable to tax as long-term capital gain. But since ICICI shares were sold immediately, this particular exemption would have been withdrawn and would have been taxed in the previous year in which ICICI Bank shares are sold as long-term capital gain. Are you understanding the difference between a non-resident and non-resident Indian? Is it clear? Any doubts? Any doubts? Sandeep, I'll share with you again that file. Any doubts in this? Did you understand this provision clearly? Do you have any doubts? This is again very, very important provision. Now, in this case, at what rate the dividends will be chargeable? Because earlier dividends were exempt. But now, in this case, the dividend income would be taxable at the rate of 20%. Dividend income would be taxable at the rate of 20% only. Clear? And here, person is not required to file ROI if only investment income is there and tax has been duly deducted on this investment income. Clear? If you do not have any doubt, we quickly move towards the next part. Raghuram, the original investment has been of RIL, right? The exemption will be available against the capital gain of RIL when the reinvestment has been made in shares of ICICI. Are you understanding, Raghuram? Any other doubt? Let's solve one sum on this before we proceed to next part. It's a past year exam question only. Let's solve this sum. And you will have to tell me the answer for this. The following data is furnished by Mr. Sumedh, a non-resident and a person of Indian origin, for the financial year ended 31st March 2019. Long-term capital gain arising on transfer of foreign exchange asset on 31st July 2018. Expenditure wholly and exclusively incurred in connection with such transfer, interest on deposits held with private limited companies, interest on government securities, dividend from domestic companies. So dividend from domestic company, for you, it will be taxable. Saving and investments, investments in notified savings certificates referred to in section 10(4)(b), investment in shares of Indian public limited companies, tax deducted at source is 1,83,000. Compute balance tax payable or refund due for AY 1920 in accordance with special provision applicable to non-resident. So you are required to tell me about this particular question. I'm giving you 5 minutes time. Whether in this case, what will be the answer? What will be your answer? Ambika, I mentioned for dividend that earlier dividend was exempt under 1034, right? Now dividend is taxable. For NRI, it will be taxable at 20% because this is what it says if you see the chart. Clear, Ambika? Kunal, I didn't get your query. What is 893 400 you're talking about? Are you able to get the answer for this question? What would be the capital gain? First, tell me that. And what will be the tax rate on the capital gain? What is your capital gain amount? No, Raghuram. How did you get this answer? The amount is not correct. Tax rate is correct. Perfect, Ambika. Very good. Absolutely perfect. Dhanush, perfect, but tax rate is not correct, Dhanush. Your answer is perfect. What about the other investment income, Ambika? Okay, so let's do it together. So if you see, this long-term capital gain is 6,50,000. Expenditure wholly and exclusively incurred in connection with this is 80,000. So that will get reduced, right? Now, the reinvestments, whether they have been made. So if you see investments in notified savings certificate, which is a specified asset, but it is made on 30th March 2019. The investment should be made within 6 months from the date of transfer. Investment should be made within 6 months. When are the 6 months ending? This is on 31st July 2018. So by January 2019, the investment should have been made. Only then exemption under 115F would have been available. So therefore, no exemption under 115F would be available in this case. Even in respect of this investment in shares of Indian Public Limited companies on 31st/12/2019, no reinvestment exemption will be available because it is not invested by 1st January 2019. Clear? So therefore, in both these cases, no particular exemption will be available. Clear? So therefore, 5,70,000 is the long-term capital gain on which how much tax would be charged? 10%. On which 10% tax would be charged. What about the interest on deposits held with the private limited companies? 5,90,000. Whether private limited companies are included? The answer is no. So it includes debentures issued by an Indian company which is not a private company. Which is not a private company, right? So interest on deposits held with private limited company is not a specified asset, and therefore this 5,90,000 would be taxable at slab rates. On this, the concessional rate would not be applicable. Clear? Concessional tax rate would not be applicable. Then interest on government securities and public limited company deposits, this will be taxable at the rate of 20%. Dividend from domestic companies would be taxable at the rate of 20%. Clear? Is it clear? Is this sum clear now? Any doubts? No, Ambika. Refund amount is 18,960. Clear? Did you get this sum? Then the another important provision I'll go through now, which is in respect of foreign institutional investors, which is provided under 115 AD. Foreign institutional investor. Clear? So in case of FII, income received in respect of securities, 20% will be the tax rate. And interest referred under section 194 LD, it will be 5%. Income by way of short-term capital gains other than listed, it will be 30%. Income in case of short-term capital gains which are on the listed shares, 15%. Income on long-term capital gain other than listed will be 10%. And income by way of long-term capital gains under section 112A which are on the listed shares, it is also 10%. Clear? Is it clear? So this is only in respect of foreign institutional investor. Any doubts? Again, these are on the gross basis. No deductions would be allowed against these particular section under chapter 6A. and it will even this first and second proviso, both first as well as second proviso to section 48, as in the exchange currency fluctuation as well as indexation benefit, both will not apply in case of this particular section of 115 AD. Is it clear? Any doubts do you have? Okay. The another important section is in respect of offshore fund on units purchased in foreign currency or capital gains arising. So income received on units and long-term capital gains in case of offshore fund will be taxable at 10%. No second proviso to section 48, as an indexation will not be available, as well as deduction under chapter 6A will also not be available. Clear? So these are some of the special provision for non-resident. And one more important provision I'll cover with you: income in respect of units of non-resident. So any person responsible for paying to non-resident or a foreign company in respect of units of a mutual fund shall deduct the tax at the rate of 20% under section 196A. This is in respect of income from mutual funds. Clear? You have to remember these sections because this could come as a part of MCQ or small sums. As I dealt with you one sum on this NRI, a sum could be captured even on FII similarly, because they also have a special rate of tax. Then one more important provision is in respect of computing the tax on non-resident sportsmen or sports association. So non-resident sportsman, including athlete who is not a citizen of India, if he participates in any game or sports other than lottery, if he contributes to any magazine or newspaper, the articles, if he does any advertisement, or a non-resident sports association in respect of amount guaranteed to be paid on sports, in respect of non-resident entertainer, any income from performance will be taxable at the rate of 20% on gross basis. Means no deduction of any expenses, no chapter 6A deduction, nothing would be allowed. Even TDS would be deducted at the rate of 20%. No return of income is to be filed if the income only consists of this income and the tax has been duly deducted. Clear? Is it clear? Which deposit you are asking, Raghuram? Let's solve one sum on the sports person. So Smith, a foreign national and a cricketer, came to India as a member of Australian cricket team in the year ended 31st March 20. He received rupees 5 lakh for participation in matches in India. He also received rupees 1 lakh for an advertisement of a product on TV. He contributed articles in the newspaper for which he received rupees 10,000. He also won a prize of 20,000 from horse racing in Mumbai. He has no other income during the year. Compute his tax liability. Is the income subject to TDS? Is he liable to require to file his return of income? What would have been his tax liability had he been a match referee instead of a cricketer? So you have to give me the answer for first 3 questions and then I'll explain you the fourth. What will be your answer? Deposit in a private limited company, Raghuram, would be taxable at the slab rate. So that 5,90,000 would have been taxable at the slab rate, which comes to 30,500. Refund comes to 10,300, Raghuram. Ambika Offshore Fund is actually a fund or institution incorporated outside India, and it has, it enters into arrangement for making some investments in India with the public sector banks usually, or with the mutual funds. Clear, Ambika? Kunal, no. Your answer is not correct, Kunal. Yes, Ambika, perfectly right. Not Dhanush. You have done some small mistake, I think. Raghuram, small mistake. You have forgotten cess amount. Perfect, Harish. Okay. So see, income from participation in matches in India, advertisement of a product on TV, and contribution of articles would be taxable at the rate of 20%, right? And income from race horses would be taxable under 115BB at the rate of 30%. Clear? So in that particular case, the answer comes to 133, 120. He is not required to file ROI if the taxes have been duly deducted. But if that would have been case, if he would not have the income from race horses. Here he has income from race horses also. Therefore, he cannot avail the benefit of exemption from filing return of income. Are you clear? That would have been the answer if there was only income from this income of the non-resident from this sports income which he's having, right? But here he is also having income from race horses. Therefore, in that particular situation, he is required to file ROI. Are you clear? Is it clear? Then the last part of the question is asking that if instead of non-resident cricketer, he would have been a match referee, would he get this kind of concessional tax rate? The answer is no. So there has been a Calcutta High Court decision in the case of Indcom, wherein they have held that umpires and match referees are professionals, but they cannot be characterized as sports person. They cannot be characterized as sports person, and therefore they are not eligible for this concessional beneficial tax rate. Clear? Is it clear? Any doubts do you have? Sandeep, did you understand the answer now? If you do not have any doubts, we can stop here. If you have any doubts, I'm ready to answer now. We are almost done with the non-resident taxation. Only section 195 is there, which we'll cover in the next class. And then we'll move into the DTAA and AR in the next class. Any doubts do you have? Are you clear with all these concepts? If not, then we can close the session for today. Yes, Sandeep. Pooja, I will share. I have shared already, but I'll ask them again. Perfect, Raghuram. Pooja, you will get all the notes. Thank you, Dhanush. Please just keep revising once again, because these are very small points and very important from your exam perspective. And even if you have any doubt, you can ask me in the next class. I'll be happy to answer. Okay, so we stop it here for today. Thank you so much. Sandeep, Abu Dhabi would be shared with you again. Yes, yes. Thank you.